My name is Farhan. Today you are going to solve question number 9 from 2014 past exam. This question requires you to reconstruct the ledger accounts for accounts receivable, inventory, and disposal of equipment. You're also required to prepare the budgeted cash flow statement by using the balance sheet provided for two periods and also the budgeted income statement. You are then required to discuss two examples for why the net profit of a business could be higher than its reported bank balance at the end of a given period. With that being said, let's get started. So you can see the question on the left-hand side, and you can get to see all the workings I've done on the right-hand side of the screen. Luz Lighting reports and budgets on a monthly basis. The business has been preparing its budgets for July 2014 and has completed the budgeted balance sheet and the budgeted income statement. Luz Lighting now wishes to prepare a budgeted cash flow statement for July 2014. So we understand that the business reports on a monthly basis, and you are given the balance sheets for two different periods: the actual results at 30 June 2014 and the forecasts for the period ending 31 July 2014. You're also given the budgeted income statement for the month ending 31 July 2014 and some additional information together with the GST clearing budgeted account. The main requirement is to reconstruct the ledger accounts for debtors control, which is known as the accounts receivable in our current study design. The old curriculum, we used to call accounts receivable as debtors control, who are the same people as the credit customers of the business. These are the people to whom the business has sold inventory on credit. Then we have stock control, which is now known as inventory, and disposal of equipment as it is. And then we are required to prepare the budgeted cash flow statement and answer the question given in part C. So on the right-hand side, you can see that I have mentioned the different terminologies that we now use for debtors control, which are accounts receivables of the business, and then stock control, which is what we now refer to as inventory. Now, based on the first additional information, it says that all sales are on credit. Okay, so all sales are on credit. So if that is the case, credit sales, whatever is reported within the income statement, is what we are concerned about for reconstructing the accounts receivable ledger account. So you can check the income statement that's given to us, and you'll see that we're given the amount for sales, which is 202,000. This is the gross sales. And then we're given the sales returns of $1,500. So using these two numbers, we first calculated the net sales, which is the difference between the sales and the sales returns. So the gross sales is 202,000 and the sales returns is 1,500, which gives us a net sales of $200,500. Now let's go back to the first line in the additional information. It also mentions that all purchases of stock are made on a cash basis, and the cost of goods sold is calculated at 50% of sales. All right, so if the net sales is $200,500, then the cost of goods sold based on the net sales is 50% of $200,500, which is $100,250. And you can verify this number by checking the budgeted income statement again, where you'll see the cost of goods sold is given as $100,250, which is 50% of the amount for net sales that we have calculated ourselves. So we understand that all sales are on credit. So let's use the gross sales amount that's given in the budgeted income statement of $202,000. In Australia, the GST applied on sales is 10%. So if I want to find the total sales, including the GST, it should be 202,000 plus 10% of 202,000, which is 222, then 200. So which is known as $222,200. And we also do the calculation for the sales returns part separately. So sales returns, including GST, would therefore be $1,500, which is the original amount for the sales returns, plus an additional 10% applied on $1,500, which makes it $1,650. So the reason we have done these two calculations separately is because we're going to be using both of these within the reconstruction of the accounts receivable ledger account. because both of these amounts could be used for calculating the net amount that we expect to receive from our debtors or accounts receivable. So let me take you to the accounts receivable ledger account outline. So as you can see, it's mentioned debtors control, which is the same as accounts receivable. Now we understand that accounts receivable are the credit customers of the business. These are the people to whom the business has made sales on credit. These people owe money to the business, which means these people represent an economic benefit to the business. Therefore, we classify these credit customers as assets, mainly current assets, because you want to get the cash from them as soon as possible and definitely within the next 12 months before you write them off. Because we classified them as assets, all assets, when they go up, we know that we debit them. So assets, when they increase, we debit them, and assets, when they decrease, we debit them. This means that if we were to prepare the ledger account for assets, the opening balance of assets should always be on the debit side, and the closing balance of the assets should always be on the credit side. So where can we find the opening balance and the closing balance for this group of credit customers who are known as the accounts receivable of the business? If you guessed the balance sheet correctly, you're right. So let's check the balance sheet, and you will see that we're given the amount for accounts receivable, which are also known as debtors control, under the current assets. And you can see we are given the actual results at end of 30 June 2014 and the forecasts at end of 31 July 2014. So the amount that we are given at 30 June 2014 of $32,700 as the closing balance will become the opening balance at 1st of July 2014, and the closing balance is $40,000 at 31 July 2014. And the main reason we are doing calculations on a monthly basis is because the business reports and budgets on a monthly basis. So let's go back to where the ledger account was given. So you can see on the debit side, we have included the opening balance of $32,700, and on the credit side, we have included the closing balance at 31st of July of $40,000, both of these numbers taken from the current assets section of the balance sheet. Now, we understand that all sales are made on credit. So during the month ending 31st of July, if I was to find the total amount, including GST, that this group of credit customers would owe us as the business, that would be calculated as $202,000 plus 10% GST applied on the $202,000, which is $222,200. So this represents the gross credit sales that we have made to the accounts receivable. So when we make these credit sales, our assets go up. How? Because we now expect more economic benefits, or we expect to receive more cash from this group of credit customers or our accounts receivable. Therefore, accounts receivable as an asset is increasing. And when assets increase, what do? We debit them. So that is why within the debit side, you can see that I've included sales plus GST clearing of $222,200. Then on the credit side, you can see that I have included the sales returns, including GST, of $1,650. So what is the basis of doing that? This is included on the credit side because this reflects a reduction in the amount that our accounts receivable now owe us. Because our assets have gone down, because they have returned all this inventory, so we have experienced a reduction in the net sales. This is reflected within the credit side of the ledger account for accounts receivable, which means that the assets have gone down. And you must include this amount, including GST, because we are collecting the entire amount from all this group of credit customers, right? Then you are including discount expense and bad debts. Both of these are non-cash expenses. And because they're expenses, where can we expect to find them? Within the income statement. So let's check the income statement, and you'll find discount expense and bad debts. Now, discount expense refers to discount that we as the business have given to our credit customers for prompt payment. So let me give you an example. Let's say today you have purchased inventory. Okay, let's change the example. Let's say today I have sold $100 worth of inventory to you on credit. Okay, so I'm the business and you are the credit customer. And I told you that if you can make the payment in 5 days, you can only get to pay $90 and you can get to take $10 off. So that $10 is what we call the discount expense, given that you have actually made the payment within the 5-day period that I've offered you. So once you have made the payment within the 5-day period, that reflects the prompt payment that I was talking about. And that is where this discount that we allow to you for prompt payment, known as discount expense, comes into play. And this is an expense for the business because we're losing this extra amount that we could have got from you. And therefore, we must reflect this within the accounts receivable ledger account, because any discount we give to our accounts receivable basically means that the asset goes down. So you can see discount expense of $1,500 on the credit side of the accounts receivable ledger account. Then we have included bad debts of $2,200 on the credit side as well. This reflects bad debts written off. So bad debts written off refers to those customers who have confirmed that they are not able to pay their debts back to the business. Therefore, this needs to be reflected as a reduction in the assets or accounts receivable that we have within the business. And because assets are going down, we are crediting them. So you can see on the credit side, bad debts of $2,200 included. So the highlighted section for bank, whatever it is, this represents the cash we have collected from our accounts receivable. And when we collect cash from our accounts receivable as an asset should go down. And that is the reason behind why we are crediting this as well. Now, this is the amount that we have to calculate ourselves as the deficit or as the missing figure. So how do we calculate this amount? Let's assume to begin with that we are not given this amount, which is obviously the case, and we're required to find this. How do we find this missing number? You find the total of everything on the heaviest side. So if you take a glance, you will know that the debit side is the heaviest side. So we find the total of everything on the debit side, which gives us $254,900, which must be the total of everything on the credit side. So once you subtract everything else that you know, starting from bad debts, then discount expense, then the sales returns, including GST, and then the closing balance, the missing balance that you need on the credit side is $209,550, which refers to the cash that you have collected from your credit customers or from your accounts receivable. So this is known as cash received from accounts receivable, and this is $209,550, which is what we're going to be including in the cash flow statement as an inflow under the operating activities section later. Right? So once that is done, let's move forward to the inventory ledger account. All right. So stock control, which is now what we call inventory. So obviously this is an asset, and all assets by default are debited within the ledger account. So opening balance should be on the debit side, and the closing balance should be on the credit side. So let's check the balance sheet for the balances for inventory, and you can see the closing balance at 30 June 2014 was $72,000, which is now the opening balance at 1st of July 2014, and the closing balance at 31 July 2014 is $90,000. So let's go back to the ledger account section for inventory. So you can see within the debit side, I've included the opening balance at 1st of July of $72,000. And on the credit side, at 31st of July, I've included the closing balance of $90,000. All right. So then I've included the cost of goods sold on the credit side because this reflects a reduction in inventory. So the cost of sales we have used here, $100,250, that was calculated based on the net sales amount. Now you can choose to find the cost of sales specific to the sales returns, and then the cost of sales specific to the gross sales, and then include two entries on both sides of the inventory ledger account. But that makes the thing complicated. So I would like you to avoid that and just do this simply. So you know the net sales, and if you want to find the cost of sales, you just simply apply 50% of the net sales, and that's $100,250. And this is 100% verified by the income statement value as well. So you have nothing to worry about. You will get full marks. So the cost of sales is on the credit side of $100,250. And the reason this is on the credit side is because this reduces your inventory. Cost of sales refers to the cost of the inventory that you had to pay before you made the sales, right? So you had to pay some money to your suppliers to bring the inventory into the business, and then you make the sale afterwards at a markup. So obviously, cost of sales here refers to the cost of inventory, and when inventory is sold, it goes down, and when asset goes down, we credit them, and that is why cost of sales is shown on the credit side of the inventory account. Then we have included inventory drawings of $3,000 and inventory write-down of $2,000. The inventory write-down refers to an expense, a non-cash expense. This could be, let's say, because of obsolescence, or let's say that some stock has been left out for so long and now you want to get rid of it. So you want to get rid of it at a significantly lower price. So that is why you're losing some money there, but you obviously need to record it, and you call that an inventory write-down. So this expense, inventory write-down, is what you can find within the income statement because it's an expense. And this is stock write-down, which is the same as inventory write-down, and that's $2,000. The reason this is shown on the credit side is because this obviously reflects a reduction in the balance of inventory, which is an asset, and assets, when they go down, we credit them. The inventory drawings of 3,000 was taken from the additional information, and this is where your focus will play an important role if you get in deciding whether or not you get full marks in a similar question in exam, which is mainly focus. So you have to read the entire question, and you can see here and there you have some complications that are involved. In the third additional information, it says that there will be no capital contributions during July, and drawings by the owner will include $3,000 in stock. So immediately when you highlight very important information, make sure you circle them or highlight them and know straight away what to do with them. So stock drawings of $3,000. So when inventory is withdrawn for private use, this obviously needs to be reflected within the business account for inventory. And what's happening within the business account for inventory? Assets are going down because of this private withdrawal. So when assets go down, we credit them, and that is why you can see drawings on the credit side of the inventory account of $3,000. So that's all we got. So the highlighted section of the debit side refers to the cash purchases of inventory, and this is validated based on the first additional information, which says that all purchases of stock are made on a cash basis. So every time we make a purchase for a stock that we bring into the business, we pay cash for it. So no accounts payable are involved here. And this is the missing amount that we had to derive ourselves in balancing this entire ledger account. So how do we balance this ledger account? You take a quick glance and you know that everything is heavy on the credit side. So you add everything on the credit side, which gives us 195,215 total, which must be the total on the debit side as well to ensure the fundamental rules of accounting apply. And once you subtract the opening balance of $72,000, you're left with $123,250 as the missing figure, which refers to the cash purchases of inventory for the month ending 31st of July 2014. And that is $123,250. This is cash paid for inventory purchases, which represents an outflow and will be shown as a negative number within the operating activities section for the cash flow statement. Okay, so let's look into the other additional information we have, and also the reconstruction of the disposal of equipment, and determine the cash we have received from the sale of equipment or the disposal proceeds. All right, so what does the second additional information say? So the second line says that equipment costing $25,000 and with the carrying value of $9,800 will be sold for cash. All right, so let's start with the first line. So the first line refers to an old equipment with a cost of $25,000 and a carrying amount of $9,800. So the carrying amount of $9,800 refers to the economic benefit that is available within this asset. All right. prior to disposing this. So if we want to find the carrying amount at any point in time, we start with the original cost and we subtract the total depreciation, right? So that's what we do to find the carrying amount. We start with the cost, we subtract the total depreciation, and that's how we find the carrying amount. In this question, in the second line of the additional information, we're given both the carrying amount and the cost, but not the total depreciation, right? So how do we find this total depreciation? You can simply find it by using algebra, where you make the total depreciation, which is the accumulated depreciation, the subject of your equation, and you start with the original cost and subtract the carrying value, which is $25,000 in original cost minus $9,800 in carrying value, and that gives you $15,200 as the accumulated depreciation for the old equipment. Then I want to also find the disposal proceeds. Now, disposal proceeds, since the question mentions that this will be sold for cash, the question explicitly mentions that. So whatever we are getting in disposal proceeds is basically the cash that we're receiving from the sale of equipment. And you could just finish it right here without doing the ledger account, but we need to do the ledger account anyway. So how do we find this disposal proceeds? So you see I've added the profit on disposal with the carrying value. Why is there a profit on disposal? Check the income statement and you will see $3,700 profit on disposal of equipment. What does this profit on disposal of equipment mean? It means that whatever our asset was worth just before disposal, we ended up selling it for $3,700 higher, all right? So whatever our asset was worth prior to disposal, which is $9,800, also known as the carrying value, we ended up selling it for $3,700 more, which is referring to the profit. So the total amount that you're receiving in cash as the disposal proceeds is the total of profit on disposal and the carrying value added together, which is $9,800 plus $3,700, and that's $13,500. Okay, so how do we calculate this? By preparing the ledger account. All right, so let's go to the disposal of equipment ledger account. And while we can prepare this ledger account by understanding the fundamental rules of accounting, for now, I'll just give you the format so that it's not too complicated for you in understanding what's happening. If you want to understand how it works on a fundamental basis, just check the link in the description to book a call with me anytime. So let me show you the disposal of equipment format. Let's just say a disposal of asset. Like how would we normally prepare the disposal account for an asset, all right? So this is in general, all right? Okay, so whenever we are disposing an asset, let's just say, so 31st of July is referring to the end of a period. So on the debit side, we show the asset at cost. And on the credit side, we show the total depreciation of the asset. If we have made any profits during our disposal, that's shown on the debit side. Again, I really want to explain how this happens based on the fundamental rules of accounting, but I believe that may be too complicated for you. So I'll keep that for a separate video. So if you had a loss, you would show it on the credit side of the disposal account. And if you have a profit, you will show it on the debit side. And this amount that you can see in bank refers to the cash that you receive by selling your property, by selling your asset. All right, so based on this format that I've drawn here on the right hand side, so let's use that and see how this can be utilized for our old equipment. So on the debit side, we got asset at cost. So the equipment at cost was $25,000, which is mentioned in the second additional information. equipment costing 25. And then on the credit side, I've included the accumulated depreciation of equipment for the period, and that is $15,200 based on our calculations. And as you can see, the disposal of asset format also shows that on the credit side. We know for sure that we have made a profit on disposal based on the income statement, which is why we are going to be recording that profit on disposal of 3,700 on the debit side based on the format you can see here. And then the highlighted figure on the credit side, which is the bank, is what we had to derive ourselves, which we had already calculated to be 30,500 based on logical exercise of how the profit and the carrying amount can give you the disposal proceeds. So let's just say you don't have it to begin with. So how would you find it? Again, you take a glance, you know the heavier side is the debit side. You find the total, which is 28,700, which must be the total on the credit side. And once you subtract the accumulated depreciation of 15,200, you get $13,500, which refers to the cash that you have received by disposing this equipment. All right, and that is $30,500. Okay. Now, I want to also show you the second line of the second additional information, which says new equipment will be purchased for cash. So we want to know how much are we paying to purchase this new equipment for cash. All right. So the balances for equipment that we are given here at 30 June 2014 are $37,000 and $42,000 at 31 July 2014 are the original costs, right, for these equipment. And by the end of 31 July 2014, this $42,000 should already have the effect for the old equipment removed, right? Because we have already disposed the old equipment. So that wouldn't be a part of this $42,000, right? Okay, so how do we figure out how much we have paid to purchase equipment for cash? So we obviously don't have to do any ledger accounts for equipment, but this is just part of our workings. So we understand that equipment is a non-current asset account because the reason it's a non-current asset is because we are going to be using this within the business for many years, and we understand that this equipment is going to help the business generate revenue for many years. Now, assets by default should always have an opening balance on the debit side of the ledger account and a closing balance on the credit side. This means that assets, when they increase, we debit them, and assets, when they decrease, we credit them. So on the debit side, you can see the opening balance on 1st of July is $37,000, and on the credit side, you can see the closing balance at 31st of July of $42,000, both of which have been taken from the balance sheet. Right. So during the period, we expect to dispose an equipment with the cost of $25,000. And when we dispose that equipment, that's going to reflect a reduction in the cost ledger account for equipment. So when assets go down, we credit them. That is why on the credit side, you can see that I've included disposal of equipment of $25,000. So this is like a cross-reference to the ledger account that we have already created, where you can see on the debit side, you got equipment at cost of $25,000. So these are all relevant to each other. And the amount for bank, which refers to the cash purchase for inventory, which is on the debit side, reflecting a fact that assets have gone up, is what we have to calculate as the missing figure. So just remove this and you know what to do. You take a glance, you know the heaviest side is the credit side. So you add 42,000 with 25,000, which you get 67,000, which must be the total on the debit side. So once you subtract the opening balance of 37,000, you're left with $30,000, which refers to the equipment that you have purchased for cash. So this is purchase of new equipment for cash. Cash paid for purchasing equipment of $30,000, which is an investing activity and is going to be shown as a negative number, referring to a cash outflow when we prepare the budgeted cash flow statement. All right. Now let's see what else do we have. So the third additional information says that there will be no capital contributions during July, and drawings by the owner will include $3,000 in stock. So we have obviously taken care of the stock drawings, which is the inventory drawings, but there's still something else to do. We understand that this could be used as a financing activity. Now, we have no capital contributions, so there's nothing coming into the business in terms of capital contribution. But we do understand that $3,000 in drawings was referring to inventory drawings. Now, if you check the amount for drawings within the balance sheet, you can see that it's $32,000 that we expect to withdraw. And drawings represents a reduction in owner's equity. So that is why when the owner's equity section is prepared, you can see the drawings as a negative number, which decreases the owner's equity. What I'm trying to say is that if the total drawings is $32,000 and we know that stock drawings is $3,000, then the cash drawings would be the difference between $32,000 and $3,000, which is $29,000. Does that make sense? So the total drawings is $32,000. Inventory drawings is $3,000. Therefore, cash drawings should be $32,000 minus $3,000, which is $29,000. And this cash drawings represents a reduction in owner's equity, which is directly relevant to the financing activity of the cash flow statement. And therefore, when you prepare the financing activities section of the cash flow statement, you will show cash drawings of $29,000 as a negative number, which refers to an outflow. All right, so let's read the next line. The loan requires one repayment on 14 July each year. So every year we make a repayment for the loan. And how do we know this amount for repayment? So you check the non-current liabilities section and you can see the loan from ABV Bank. It is $22,500 at end of 30 June 2014. But we expect it to go down to $80,750 at 31 July 2014. So this refers to reduction in loan, which in other words is also known as loan repayment. So how much are we repaying for a loan? The difference between $22,500 and $80,750, which is $3,750. So this is the loan repayment of $3,750, which is a financing activity and needs to be shown in the cash flow statement within the financing activities section as an outflow because we are using cash loan repayment of 3750. Okay. We also understand that the question mentions that the loan is paid once every year on 14 July. All right. So every year once the loan is repaid. And that is why when you check the current liabilities, you will see that at end of 30 June, we have 3750, which is a liability referring to the loan that we would be paying on 14 July. But then again, next year, 14 July 2015, we'll be paying 3750 again. And that is why rather than seeing a zero here, which is not the case, you see an additional 3750, which refers to the loan that you will repay in 14 July 2015, right? So this one referred to 14 July 2014, which is what we already have repaid, and therefore needs to be shown in the cash flow statement. But the other one of 3750 at 31 July 2014 refers to the current liability within the next 12 months in 14 July 2015. All right? Okay. What else do we have? So we see that the budgeted GST clearing account for July has been prepared and shown below. No payments to or refunds from the taxation office are expected in July. So this is talking about the GST settlement, not the GST paid. All right. So GST settlement is basically done after you know how much you have paid in GST and how much you have collected in GST. But you still have to pay GST whenever you're purchasing something, and you still have to record the GST whenever you're collecting it in terms of cash from your customers. Okay. So let's move on to the second part of the question, which is to prepare the budgeted cash flow statement for the month ending 31 July 2014. Right. So I've already prepared it. Starting with the operating activities section, we included the cash received from accounts receivable of 209,550, which is what we have derived when we prepared the ledger account. And then we included cash paid for inventory, and that's in brackets to reflect an outflow. Then we have included other expenses of 14,100. Where did we get this from? We got this from the budgeted income statement. And we can confidently say that this other expenses has been paid for in cash because you can check the current liabilities section of the balance sheet and you will see that the only expenses that are accrued is the wages. And if you check the current assets, the only expense account that needs adjustment is the prepaid advertising. So these are the two accounts that we have to do some adjustments for. And the rest has already been paid for in cash. Whatever cash expenses you have, I mean, not the non-cash expenses. So we have other expenses of 14,100. We have interest expense of 1,100. We are not including depreciation, discount expense, and bad debts because they're non-cash. And we are left with wages and advertising, and we are going to be doing some calculations for those relevant amounts. But for now, we know that interest of 1,100 has been paid for in cash, and other expenses of 14,100 has been paid for in cash. And we can guarantee this because the balance sheet has no accounts in current liability or in current assets for these expenses, which refers to the fact that everything has been up to date. Yes. All right. So interest paid. So let's see interest paid of $1,100 in negative, and then you got other expenses of $40,100 in negative. So we have already understood this line, this line, this line, and this line. All right. So we are left with advertising paid, GST paid, and wages paid. So where did we get the amount for GST paid? Remember, I was telling that I was just mentioning a while ago that GST settlement is not the same as GST paid. GST settlement is the net amount, but GST paid could be any time you purchase something or pay for an expense. All right. So where did we get this amount for GST paid? It's on the debit side of the GST clearing account, which is 70,865. It clearly mentions bank, which is the reason for why we included GST paid of 17,865 here. In negative, obviously. All right, so we know that we are given accrued wages and we have to prepare the ledger account for accrued wages to calculate how much we have paid for in wages. So accrued wages is a current liability account, which means that the opening balance should be on the credit side and the closing balance should be on the debit side. So where do we get these balances from? Check the current liabilities section and accrued wages. The closing balance for 30 June 2014 is $2,500, which is the opening balance at 1st July 2014, and the closing balance at 31 July 2014 is $1,500. So both of these amounts are included here. Opening balance of $2,500 on the credit side and closing balance of $1,500 on the debit side. Then I've included the wages expense of $27,000 for the period, and that is taken from the budgeted income statement. All right. So I've included that on the credit side. And how does this work if I was to generalize this? So let me show you how this makes sense. So wages expense by default should always be debited in itself. But we understand that the business has some accrued wages, which means that wages are paid after a time period has passed. For example, after the week has to pass and then you pay for it next week. And that is why the accrued wages could exist. So anytime the business incurs wages expense, it's going to be recorded if we were to prepare a journal entry like this. It would be counted as a current liability unless it is fully paid. All right, so debit wages expense 27,000, credit accrued wages of 27,000. That is why you are seeing that within the credit side of accrued wages, you're including wages expense of 27,000 for the period. So this amount for bank on the debit side refers to the wages we have paid. And obviously, if you want to calculate this, we use the same strategy as before. Find the total of everything on the heavier side, which is the credit side. That is 29,500, which must be the total of everything on the debit side. And once you subtract the opening balance of 1,500, you get $28,000, which refers to the wages that we have paid for in cash. This is an operating activity, which is included here. All right, so that's also discussed. So the only thing remaining now is advertising paid. Right. So I've here a ledger account for prepaid advertising. So prepaid advertising is an asset account. All assets, as we know, by default, should always have an opening balance on the debit side and a closing balance on the credit side. So when you check the prepaid advertising, there's no opening balance, but the closing balance at end of 31 July 2014 is $3,000, which is what you can see we have included here on the credit side. Again, we have advertising expense of 9,300, which is included on the credit side here. And this amount is what we calculated ourselves, the amount for bank for the period ending 31st of July, which refers to advertising paid, and that is $12,300. This is what we calculated based on what we had to balance. I think you understand this, but I want to explain something else here. You see how the advertising expenses on the credit side of the prepaid advertising account. What is the logic here? We understand that we at prepaid advertising, so every time the prepaid advertising is consumed, it will reflect a reduction, and that is why we'll be crediting it. But at the same time, we also have expense advertising, and we would have to debit it because expenses are always debited when they increase, right? So that is why, as you can see here, prepaid advertising is crediting because we have consumed the benefit that comes with the prepaid advertising, and therefore it has been classified as an expense. So in the credit side of the prepaid advertising account, we have included advertising expense to reflect that reduction. The reason this is on the credit side is because when assets go down, which is the prepaid advertising, we credit them. That is why we are doing this. So let's go back to the operating activities section. And you can see advertising paid of 12,300 negative as well. So now you add everything up. Add and subtract whatever you need to do, and you should see the net cash from operating activities to be 12,935 positive. Make sure to write the entire thing, net cash from operating activities. I just didn't have enough space, so I got lazy and I wrote net cash from operating. Okay. Now let's discuss the next section of the cash flow statement, which is the investing activities. Now, investing activities only refers to purchases that we make for non-current assets or any sale of non-current assets. The only non-current asset we have sold was the equipment, and the only non-current asset we have purchased was also the equipment. If you recall, we have prepared the ledger account for equipment, and we found the cash paid for new equipment purchase was $30,000. And that is why it's included here. Purchase of asset, $30,000 negative to reflect the outflow or cash paid. And proceeds from sale of equipment was $30,500, which is also something we have calculated ourselves, as you can see here. Profit and disposal plus carrying amount, which gave us $30,500. And this is disposal proceeds, which is cash inflow, and that is why it is shown as a positive here. So these are the only two lines, only two items to take care of. So once you do the calculations, you get negative amount. So net cash flow from investing activities is actually negative 16,500, right? So this is what we have shown here. So net cash flow from investing, negative 16,500. Okay, so we have the total for operating and we have the total for investing. Next, we start with the financing activities section. And for the financing activities section, there were only two items which we already have discussed. Loan repayment of 3,750, which is shown in negative, obviously because we're repaying it, and this refers to a cash outflow. And then we're showing cash drawings of $29,000 in negative, referring to an outflow. And this was calculated by subtracting the stock drawings of $3,000 from the total drawings of $32,000 that we were given within the owner's equity section of the balance sheet. Okay. And the net cash from financing activities was negative 32,750. Right. So what you do now, so you take 12,935, you subtract 16,500, and then you subtract 32,750, you get a negative amount of 36,315. And because this is negative, we call this a net decrease in cash or net decrease in bank balance, whatever you want to call it. I just don't have enough space here to write that, but you get the idea. And then you add the opening balance. I've just written OB because I got lazy. So opening balance of $27,320. This is a positive number, which means this should be an asset. Let's verify that. Check the balance sheet. And you will see that the cash at bank was a current asset of $27,320 at the end of the previous period, which is the opening balance at 1st July 2014. So we have added that. So once you do the calculations from minus 36,315 plus 27,320, you get negative 8,995, which must be the closing balance that you have. And because this is negative, this is referring to a current liability or bank overdraft. Let's verify that. You can check the balance sheet. You can see that we do not have any assets for bank, which means we really did not have any money in the bank account. We, in fact, overdrawn the bank balance, and that is 8,995, current liability, referring to a deficit or a negative amount. All right, and that's how you know your math is 100% correct for everything that you have done so far, and you will be very confident when you achieve that in exam. Okay, what about part C, which is the discussion question? All right, so part C is asking us to explain, giving two examples, other than the loan repayment and drawings, how the business can budget for a net profit of $43,550, as you can see here, and have its budgeted bank balance fall, which is what we have calculated to be negative 8,995 based on our closing balance. And this is validated or verified by the bank overdraft within the current liabilities section for 31 July 2014 of $8,995. All right, so two examples. Now, within the net profit calculations, if you check, you can see that the wages expense is $27,000, right? So the wages that we have expensed for the month of July is $27,000. But when you check the operating activities section of the cash flow statement, you can see that wages paid is higher at $28,000. Okay, so I'm going to be using more than two examples. I know this example is not substantial to explain that effect, but we're going to start with wages paid. Then, what else do we have? You can look into advertising expense, which is $9,300 for the month of July. But based on our calculations, we also know that we have paid for prepaid advertising other than the expense that we have consumed in the month of July. And that is $12,300 negative, which is again pointing to the fact that advertising paid for cash is higher compared to the advertising expense in the calculation for net profit. Then a very important one is actually the purchase of asset, which is the purchase of equipment for $30,000. Because this purchase here refers to an outflow, which caused the bank balance to decline significantly. And this purchase refers to the purchase of non-current asset, which is definitely not the case when we find the net profit for the income statement. Net profit is simply calculated by taking all the revenues and subtracting all the expenses. It has no record for purchase of any assets. It only records the depreciation, which is obviously not going to be substantial at all. So the purchase of asset of $30,000 is one good example that you could use as well. Then you could talk about GST paid of $17,865. So GST paid is not an expense nor a revenue. This is the GST you pay when you make purchases for certain items. So this could be relevant to purchases of stock. This could be also relevant to any expenses that you're paid for in cash. So GST will not be included as part of the profit calculations, but definitely will be included in the calculation for the cash flow statement. So these are the two major ones, if you can talk about this too. And that should be enough for you to score a full mark, 4 out of 4. And then 9 out of 9 for part B and 8 out of 8 for part A. So 21 out of 21 easy for this question. Right, so that's all for today's lesson. I believe you found a lot of value in this content. Make sure to check the link in the description to book a tutoring session with me, to book a call with me. And with that being said, I'll see you in the next lesson.